David Houghton, who's MD, PVM Oil Associates, and he joins us on the phone line from London to give us his sense on where he sees the sector headed. David, hi, it's such a pleasure having you on the show. First of all, how do you read the crude oil prices, the moves that we have seen in 2016 till time?
Well, good morning. Nice to be with you. The prices at the moment, I think, are reflective of the whole sequence of short-term supply outages that we've experienced over the last few months. The prices definitely would not be this high without these outages. So what we've done is, what we're seeing effectively is an advancement of the tide to market that we had expected in the second half of the year, which has been brought forward.
David, how long do you see these outages lasting? I mean, do you see the supply come back into market? Do you think that would put pressure yet again?
Well, we've learnt this morning that the fires in Canada are probably worsened and have now moved north and are threatening the oil sands facilities. So the Canadian situation looks as though it will continue now for much longer than originally thought. And the situation in Nigeria doesn't look as though it's resolving itself with the militants threatening to do even more damage. So these outages are not 1 or 2 day affairs. It looks as though they're going to be for the remainder of the month. And if we can get through the second quarter of the year, which was expected to be very weak, with these outages supporting prices, then I suspect we can look forward to higher prices in the second half of the year.
David, you are one big name when it comes to the energy sector. Where do you see the prices headed now, and whether or not the OPEC production is expected to see any cuts coming forward?
Well, we won't be seeing any cuts from OPEC. I think that's pretty clear. We'll see extra coming from Iran, and we don't know whether Saudi Arabia will increase production, as they've hinted that they might. And as far as the forward prices are concerned, I think it's food for thought that if Brent were to match last year's average price, then it would have to average $62 a barrel for the remainder of the year. So there's plenty of headroom for the price to move to between $50 and $60 a barrel. And for the moment, the signs are that is likely to happen, I suspect.
David, also there have been reports from EIA on how the non-OPEC supply seems to have declined. Do you see that supporting, and do you see that sustaining?
I think that's very supportive. I think the majority opinion appears to be that non-OPEC production will fall this year by of the order of 700,000 to 800,000 barrels a day. That compares to a huge increase last year of 1.6 million barrels per day. And I think that at $50 a barrel, that will not trigger much in the way of slowing down of these cutbacks. $60 a barrel would appear to be the number that is the consensus that might bring back some U.S. production. So the safe price range to talk about perhaps is the $50 to $60 a barrel price range before non-OPEC comes back.
David, also, I mean, you talked about U.S., and that, of course, is what really led to the decline in the first place. And, of course, the Fed meeting, as Fed interest rate hikes, as markets started to watch that. But going forward, just to talk about the U.S. supplies, where do you see them going? Because there have been reports on how so many of, North Oil companies have asked for protection against bankruptcy there.
Yes, I mean, bankruptcy itself doesn't necessarily mean that production is cut. The people who take over these assets will then start pushing them as hard and as fast as they can. And forward production, I'm afraid, we have to come back. It's a full circle. Forward production will depend totally on where the price arrives at. And $60 a barrel, we will probably not see the falls next year that are currently predicted. Incidentally, I should point out that the big thing to watch for, the big other elephant in the room, is what's happening in Venezuela, which is really quite worrying as such a big producer in such apparent difficulty.
So, David, while we would agree that there are so many fundamentals which have been supporting, but how would you look at the speculative activity? Because there are so many money managers there who did put out net long positions to record highs, and that's one movement which perhaps is making the market so volatile.
Well, yes. I mean, we do have these record highs. I think the bigger factor is the fact that we've got far less short positions than we've had in the market of late. And in principle, of course, at $50 or $60 a barrel, if people were to start heavily shorting the market, then then we'll see the price turn back. But I think we can fairly say that the rally that we're seeing at the moment is not speculatively driven. There do seem to be some real fundamentals behind it.
So, David, then while you did say that $60 on the higher side is a possibility there, if there is a profit taking, because we are at, it's overbought if you ask the chartists. In that sense, if the prices do decline, where do you see a support?
My own bottom price range would be at the $40 a barrel level. I mean, I think everyone would agree that $27 was a huge, exaggerated move, the sort of thing that does happen in markets like oil, and that perhaps a $35 level would have been a more natural level for it to have fallen to. So for me, the price range is $40 to $60 a barrel in terms of the bottom and the top.
David, thank you so much. Really appreciate you taking time out for us and talking to us at CNBC TV 18. Well, that's an exclusive, really. David Houghton talking for the first time to an Indian channel. And he's saying that $40 to $60 is the kind of range that he sees for the rest of 2016. And the volatility, of course, may just about continue there. But with that, let's take a very short break. When we come back, we'll have Kunal Shah of Nirmal Bang Commodities joining us with his strategies.